Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore, and in this video we will see what changes have recently been brought under IAS 8 or Ind AS 8, which deals, apart from other things, on accounting estimates. Now we will see that a new definition has been given under the amended standard to accounting estimates, and few clarifications have also been issued by the accounting standard setters in terms of explaining how to really apply these accounting estimates. So just to set the context, let us first understand why there was a need for a change for accounting estimates. So let's see what was the issue, what led to the problem. Now, you may be already aware that from an accounting perspective, distinguishing between accounting policy and accounting estimate is very, very important. Why so? Because under IAS 8 in IFRS world or Ind AS 8 from an Ind AS perspective, changes in when it comes to changes in accounting policies, they are generally applied retrospectively. However, change in accounting estimates, they generally are applied prospectively. And therefore, it is very much important to really distinguish between the two concepts of accounting, change in accounting policy or change in accounting estimates. To give a simple example, let's say if this is the timeline, a company is already existing, let's say it started operation at this point in time, and subsequently at this time, let us say there is a change in accounting policy. Now, what both IAS 8 and Ind AS 8 says that whenever you have such change in accounting policy, then the effect of such change has to be given retrospectively as if this accounting policy was always existing. Thereby meaning that change in accounting policy is given effect to retrospectively by restatement of the comparatives of the prior period. Unless, of course, the restatement of prior period is impracticable, or let us say this change in the accounting policy is on account of a newly notified standard when you first time apply a new standard, and that standard carries any transitional provisions or transitional relief. If in these two circumstances, you may not apply retrospective restatement of your comparatives, but in general, if an entity changes its accounting policy, then the effect of such change has to be brought in with retrospective effect. Unlike that, let us say subsequently there is a change in accounting estimate. Then in that case, the standard requires that this change in accounting estimate is to be accounted for prospectively, either only in the current period when the change is being incorporated, or in current and future period if the change in the estimate impacts not only the current period but also the future period. So therefore, the distinction is very important because the accounting requirements are different depending upon whether you are doing a retrospective assessment, retrospective a restatement, or a prospective change. It will impact both the reported P&L, reported results of the operations of the entity, and the trends in the profits for various periods involved. And this is the sum and substance of why one need to be really careful in distinguishing between a change in accounting policy and change in accounting estimates. Now, considering this background, when it comes to the actual practical implementation of change in accounting policy or change in accounting estimates, there were a lot of diversity in practice. Okay, because various entities interpreted these differently, and therefore stakeholders noted that prior to the amendment there was a wide diversity in practice with whether a change is an accounting policy or a change in accounting estimates, because the reason why there was a change in accounting, there was a diversity in practice, because the term accounting estimate was before the amendment was not defined in the standard. What the standard used to do, the pre-amendment standard, it used to define what is an accounting policy, and it has given, by way of example, what is change in accounting estimates. But the definition of accounting estimates per se was not there in the pre-amended standard. And this led to problem in terms of the actual implementation of these two terms. That's what it says, because the term accounting estimates was not defined before the amendment, and the previous definition before the amendment only carried, this is the change in accounting estimate, and therefore the distinction between the change in accounting policy and change in accounting estimate before the amendment was not very clear, which led to diversity in practice. And because of which this basically led to the improvement and amendment to the requirements of IAS 8 or Ind AS 8. So this new amendment to these two standards clarify how companies should distinguish between these two terms. Therefore, it is expected that this amendment will bring in uniformity in the application of these two terms, and this diversity in practice which was witnessed in the past is likely to either go away or significantly reduced. Right? This is the primary focus of the amendment. So the amendment primarily focuses on defining what an accounting estimate is, giving examples of situations when the change is to be considered as accounting estimate. We will see all of that in the subsequent slides. So let us see first what additional guidance have been provided by the amendment. So what the amendment has given clarity, let us see. So what has changed after the amendment? First thing first. The amendment, as I indicated, has now introduced the definition of accounting estimates. Because pre-amendment, there was no definition of the term accounting estimate. And now, paragraph 5 of the amended standard, both under IFRS and Ind AS, it defines what an accounting estimate is. So if you see, this is how accounting estimate have been defined under the standard. So paragraph 5 says that accounting estimate is monetary amounts in the financial statements which are subject to measurement uncertainty. What does it mean? When you say measurement uncertainty, what it means? Paragraph 32 of the amended standard, it gives additional guidance on what this expression measurement uncertainty is all about. So it says, paragraph 32 says that measurement uncertainty is the uncertainty which arises when monetary amounts in the financial statements, in the annual reports, they cannot be directly observed, and therefore those monetary amounts need to be estimated. So if you have certain number in the annual report which cannot be directly observed, rather it needs to be estimated, that falls within the expression of measurement uncertainty. Now, it is also worthwhile to recall that accounting policies, they require the transactions and the balances in the financial statements to be measured either by direct observation, which is from the directly observable basis, or on the basis of some estimates. So sometimes these transactions and balances, they are easily observable. For example, simple thing. Let's say, what is the amount in the invoice of a supplier? So that is a quantified number. By looking at the invoice, you know what that amount is. However, in certain circumstances, in many circumstances rather, these values which you need to report in the financial statements, they are not directly observable. And therefore, there is a need to estimate those monetary amounts. So for example, under Ind AS and IFRS, you have lot of circumstances in which fair value of the asset need to be recorded. Now, fair value of the asset need to be either recorded or disclosed. Now, this cannot come directly. This is not directly observable, and therefore these need to be estimated by using various parameters. For example, by applying the principles given in Ind AS 113 or IFRS 13, which deals with fair value measurement. So therefore, in these circumstances, accounting estimates are required to be developed because the numbers are not directly observable. If the numbers are not directly observable, the monetary amounts are not directly observable, then entity need to develop it. Develop in such a way that the number achieves the objective set out by the accounting policy. So if your accounting policy is to measure certain asset at fair value, you will develop accounting estimate in such a way that that objective of measuring the asset at fair value is accomplished. Okay, which typically will involve the judgment and assumptions by the entity when they are developing these estimates. And how these judgment and assumptions and estimates are being made on the basis of the which are reliable, which an entity can make use of. That's the way the estimates are developed. So if you look at on the right hand side, paragraph 32A, a newly inserted paragraph in IAS 8 and Ind AS 8, it gives you additional guidance in terms of how these accounting estimates are developed. So paragraph 32A says that generally when entities are developing these accounting estimates, when they are estimating these numbers or these amounts, generally to develop the accounting estimates, an entity selects a measurement technique and also the inputs which go into these measurement techniques. What does it mean? So simply stated, let us say an entity may select a particular estimation technique or a valuation technique, right? So for example, if you look at Ind AS 113 or IFRS 13, you have three broad valuation techniques, right? You might already be aware. So you have the cost approach, you have the income approach, and you have the market approach. Now these are the measurement techniques. Let's say if an entity is using an income approach. Now in an income approach, how do you apply that income approach? Basically by applying the discounted cash flow method. Now in DCF method, when you apply the DCF method, you try to arrive at a single number. And how that single number is arrived at? Typically by discounting the cash flows. Let's say cash flow 1, there are 3 periods in which the cash flows are expected from the asset. So the cash flows associated with the asset discounted by an appropriate discount rate will give you the fair value of that particular asset using the DCF or the income method. Now in this case, the DCF method represents a measurement technique. But the discount rate which you use to arrive at the number is like an input which go into the DCF method. So that's what paragraph 32A says. Paragraph 32A says that generally to come out with the accounting estimate, entity will select a measurement technique like a valuation technique or an estimation technique, the example of DCF technique which I told you. And the inputs which also the entity need to select, like the discount rate, in applying this measurement or the valuation technique. So selected by the entity. And therefore, if you look at this particular chart, it summarizes all what is paragraph 32A says. So paragraph 32A says accounting estimates are developed by the entity by selecting these two things, measurement techniques and inputs which go into those measurement techniques. Now, these basically, we have already seen that these measurement techniques could be estimation technique or valuation technique. Now, typically, these estimation techniques are used to estimate expected credit losses. Let's say the bad debts or provision for bad debts provisioning under financial instruments standard, which is IFRS 9 from an IFRS perspective or Ind AS 109. Or say for example, value in use, when if you are estimating the value in use of a cash generating unit under Ind AS 36 or IAS 36 impairment standard. So this is the estimation technique is typically used in these circumstances. Further, when it comes to the valuation techniques, as I mentioned, income approach, market approach, your cost approach, these typically are used, valuation techniques are used to determine the fair value as contemplated under Ind AS 113 or IFRS 13. Right? So this is what the guidance given in paragraph 32 is. Now, paragraph 34A of the newly, I would say the amended standard, it also tells you that the effect of change in these measurement techniques and or the inputs, they are change in accounting estimates. So if you change any of these, if you change the measurement technique or you change the inputs which go into the measurement technique, and because of which there is a change in the number, the effect of changes in this measurement technique and the inputs is a change in accounting estimate and not change in accounting policy. Unless these changes are a result of correcting a prior period error. If something you have done wrong in a prior period and then you are correcting it, then it's a different thing. But in general, when an entity is changing these, then the outcome of that, the effect of such change is considered as a change in accounting estimates as clarified by paragraph 34A of the amended Ind AS 8 and IAS 8. Okay, that's how you have to read the requirement of the new standard. Also, paragraph 35, if you see at the bottom, paragraph 35 says, however, a change in the measurement basis applied will be a change in accounting policy, not a change in accounting estimates. This is a clarification given in paragraph 35. What does it mean? So, for example, let us say you were following the FIFO method of inventory valuation. Now, you change from FIFO to weighted average. Now, this is the basis change. So, there is a change in the measurement basis from FIFO to weighted average. This change will be considered as the change in accounting policy, not change in accounting estimate. However, change and the resultant effect of the change in the measurement techniques or in the inputs will be change in accounting estimates, paragraph 34A. Right? Let us see further in the next slide and continue our deliberation in this, that what has changed after the amendment. Now, it doesn't stop here. To better implement and appreciate what these changes are, paragraph 32 gives illustrative examples of what are accounting estimates. So, for example, the amendment include these 5 examples of accounting estimates. So, for example, if you are recording the loss allowances for expected credit loss, the piece which I said, the provision for bad debts, for example, that is under Ind AS or IFRS 9, Ind AS 109 or IFRS 9. That is an example of accounting estimates. Same way, if you are valuing inventory at cost or NRV, whichever is lower, under Ind AS 2 or IAS 2, this is also an example of accounting estimates. Same way, fair value of assets or liability, recording depreciation expense, and provision for warranty expenses or obligation, they are all examples of accounting estimates as given in paragraph 32 of the amended standard IAS 8 or Ind AS 8. Also, paragraph 34, it tells you and gives you additional clarification. It says that the clarification says that a change in the accounting estimate that result from a new information or that result from a new development or more better experience which you have is not a correction of error. Rather, it's a change in accounting estimate. So, for example, let us say some information was not available to you in the past. It's a new information which comes to you. And now you make use of this new information and update your accounting estimate or update your numbers. That will fall in the definition of change in accounting estimate because This is a new information. You never had this information in the past. You are applying a new or a better information. And because of which you are coming out with a better, reliable number of the estimate. That is a change in accounting estimate, not a correction of error. The same way, if you have a better experience, so you were applying some basis on which, let us say, your warranty provision you were recording. Right now, based on your prior experience, you have a better information. You apply your historical experiences, and now you use that information which you have got historically, and then you improve your estimation. This will also fall within the category of change in accounting estimates, not correction of prior period error. This is a clarification given in paragraph 34 of the amended standard. Now, again, paragraph 32b. See, there are so much of the emphasis which have been given on accounting, for change in accounting estimates. A lot of guidances have been given. See here, this is very, very important for you to understand, because a plain reading of the standard, you will not be able to appreciate what they are saying. If you look at paragraph 32b of the standard, it says the term, see, we are saying accounting estimate. And in the normal accounting, you always loosely say estimates. So this paragraph 32b says that the term estimate, which you generally use in accounting, need not necessarily always be equal to accounting estimates as contemplated under this standard. So let us read what the standard tells you, what is the guidance given in paragraph 32b. So paragraph 32b of the new standard, or the amended standard, it says that the term estimate is widely used in accounting and may sometimes rather actually refer to estimates other than accounting estimate as contemplated under this standard. Therefore, the amended standard clarifies that not all estimates are equal to accounting estimates as contemplated under this standard. So not all estimates will meet the definition of accounting estimates as contemplated under this standard. Rather, these estimates in many cases may actually represent inputs which are used in developing the accounting estimates. So for the example which I gave, the discount rate which you use for applying your DCF method, you are estimating the discount rate also. But that estimate is not an accounting estimate per se. It is an input to the DCF method. That's what the clarification is given by paragraph 32b. Accordingly, now with so much of emphasis given, with a view to help the entities to understand and apply how one should understand and apply the amended requirement, two new examples have been incorporated in the guidance on implementation of Ind AS or IAS 8, which is accompanying the standard. The two new examples are example 4 and example 5. They have been added so that the users of the financial statement, they are able to appreciate what is change in accounting estimates or accounting estimates per se. So if you look at example 4, this newly inserted example, this deals with fair value of an investment property. Of course, under Ind AS, fair valuation of investment property is not allowed from a recording perspective. Only for disclosure of fair value is what you need. The fair value of investment property from an Ind AS perspective. But from IAS perspective or IFRS perspective, under IFRS literature, investment property can be recorded at cost or fair value at the choice of the entity. Of course, this fair value choice is not there under Ind AS. But this example 4, let us say from an IFRS perspective, it talks about the fair value. It says fair value of an investment property. For example, if let's say assume an entity was using the fair value basis for valuing the investment property. So if an entity elects to change the valuation technique, we have seen the valuation technique, I have told you, there are three broad category of valuation technique under Ind AS 113 or IFRS 13. The cost approach, the income approach, and the market approach. Now that's what it says here. If an entity elects to change the valuation technique from income approach to market approach, if you move from here to here, due to a change in the market condition, assume that now the market information is available, right? This example talks about this, and in the next slide I'll explain this example, how this example 4 clarifies the position. But here in this slide I'm just narrating and explaining to you what this example 4 is all about. Likewise, example 5, which has been newly inserted in the amended standard, is this talks about liability. If there's a change in liability in respect of a cash settled service payment award. So if an entity changes the estimate of the expected share price volatility in the option pricing model as a result of change in the market conditions, then should that change in the basis in the option pricing model, should it be an accounting estimate or not, is what is being dealt with in example 5. Now, you might already be aware that there are option pricing model, let's say your Black-Scholes model. Now, Black-Scholes model gives you the basis using which option pricing can be valued, or the options, let's say, which you have given to your employees need to be valued. So option pricing has like binomial model, you have the Black-Scholes model. Now, one of the inputs in the Black-Scholes model happens to be estimated share price volatility. Because if you look at options pricing model under Black-Scholes, it says if the volatility is more, it has a direct bearing on the pricing of the option. I mean, that's a separate topic altogether. Maybe at some time we will cover, later we'll cover it. What I'm trying to say, let us say if you have a Black-Scholes model, there are various inputs which go into the valuation technique using this option pricing model, and then you arrive at the final value of the option. Now, if one of the inputs, which is the expected share price volatility, if that is being changed as a result of change in the market condition, now whether this will result in the resultant amount, there will be a change in the valuation of the option. Now, whether that has to be reckoned as the change in accounting policy or change in accounting estimate, that is what the guidance is given in example 5. And both these examples I will cover how in the next slide in terms of how the standard explains that these are the change in accounting estimates and why. Let us see this. So I have brought forward these two which I have already explained to you in the previous slide. So let us see one by one. Let us first see on the left hand side example number 4. That here you have a change in the valuation technique wherein the entity is moving out of the income approach and now going into the market approach. You are going by now the market approach. So in this case, the standard gives you, by the example 4, gives you the guidance and says that fair value of the investment property, this is an accounting estimate. Why? Because they are linking the justification of this to the definition of accounting estimates, which we saw in the earlier slide. Why so? Now see the explanation. Because the fair value of the investment property is a monetary item, is a quantified amount which go into the financial statements. And that is subject to measurement uncertainty. Why? Because the fair value cannot be directly observable. You have to estimate it. Therefore, the first point says that the fair value of the investment property is a monetary amount which goes into the financial statements and is subject to measurement uncertainty. And the fair value of the investment property is effectively an output of the measurement technique. Now, if you are using the income approach, then the fair value is the output of what? So, for example, if you are using the income approach DCF method, you will look at the likely cash flows, which is expected to arise from this particular investment property and then discount it. The result of that is your fair value of that investment property. So, the fair value of this is the output of the measurement technique of the DCF technique used in applying the accounting policy. The second point. And the third justification is that in developing the estimate, the fair value of the liability, the entity uses the judgment and assumptions. For example, discount rate. The discount rate is something where they will apply judgment, which discount rate to use. And therefore, the example 4 clarifies that the change in the valuation technique in these circumstances, wherein you are moving out of income approach and now embracing market approach, this change in approach is a change in the measurement technique applied to estimate the fair value of the investment property. And we have seen in one of the previous slides, a change in the measurement technique or the inputs is invariably change in accounting estimates, unless it is on account of the prior period error correction. So therefore, the effect of this change is a change in accounting estimate, because the accounting policy of valuing the investment property at fair value, that is not changing. What is changing is the process by which you arrive at the fair value. Therefore, if you look at here, the net summary of this is example 4 says that if you are moving from this to this approach, this is a change in accounting estimate, because your policy of valuing the investment property at fair value remains unchanged. Look at on the right hand side, the example 5. Now here, just to recall, what is example 5? Example 5, as I told you, an entity is changing the estimate, because in the Black-Scholes model, if you have multiple variables which are there, which go into the calculation. Now, one of the inputs, which is expected share price volatility, if this basis is changing as a result of change in the market condition, that means one of the inputs going into the valuation methodology is changing. So in this case, also example 5 clarifies that if you have such a scenario, fair value of the liability for such service payment award is a change in accounting estimate, because same, all these three logic apply here. Because the fair value of the liability again is a monetary amount. You're computing using the Black-Scholes model, you are computing an amount. You can't directly observe the fair value of such options. Therefore, you are estimating, and it is subject to measurement uncertainty, and it is this fair value is a result of the measurement technique. You are applying this technique of Black-Scholes model and coming out with the final output. And to estimate this fair value of the liability, entity is using judgment, because all of these inputs which go into the measurement technique entails some amount of judgment and assumptions which the entity makes. Right? Therefore, same just like example 4, example 5 also concludes that the change in this share price volatility is a change in the input used. See, in this case, it was a change in the measurement technique which is being applied. Here, it is a change in the input used to measure the fair value of the liability, and therefore, this will also be the change in accounting estimate, not change in accounting policy. Why? Because your accounting policy was to measure the liability at fair value. The liability on the cash settled SBP award has to be always measured at fair value. That policy is not getting changed. What is getting changed is the process of valuation of that particular liability. And therefore, in both these examples, the standard clarifies that both basically fall in the category of change in accounting estimate because of the reasons listed here. Right? That is how you have to look at these new and amended requirements of IAS 8 and Ind AS 8. Now, what about the effective date? From when they are effective? From an IFRS perspective, which is in IAS 8, these amendments are already effective from 1st of January 2023. So all reporting periods on or after 1st January 2023, these amendments are effective. And from an Ind AS perspective, they are effective from 1st April 23. That means for financial year, starting financial year 23-24, these changes are applicable. So this is what I wanted to cover for this particular video. I will continue my endeavor on sharing the knowledge which are in the various domains, not necessarily accounting. It can be accounting, tax, your international tax, ESG, whatever. Okay. This is my contact details. This is the link of my YouTube channel, and this is the page of my LinkedIn profile. Please connect with me subscribe to the channel, the YouTube channel, comment, share, whosoever need this kind of information is something which you can, I would appreciate if you can really share and help the channel in whichever way you can. Thank you. This is what I wanted to cover. Take care, and I'll see you in another video. Thank you. Bye for now.